There's hundreds of different companies across every industry imaginable that all pay dividends. How do you know what to look for when picking dividend stocks? That's what we're going over in this video. But first, if you enjoy the video and find it useful, be sure to like and subscribe and leave any other tips you may have down in the comments. And with that, let's get right into the video. I think the best way to demonstrate how I look for a new dividend company is by going through an example with one that I haven't purchased yet, but I'm thinking about doing so in the future, especially after going through the analysis in this video. So we're going to be looking at Walgreens. One important thing to look into before starting a position is to see if it's trading at a reasonable price. There's many ways to check to see if a company is trading at a good price. One of the most common ways is by looking at a company's PE ratio. Right now, Walgreens has a forward PE ratio of 10.5, which doesn't really mean anything on its own. We need to compare to other companies in the same and similar industries to see how they compare. One of Walgreens' biggest competitors is CVS. CVS has a forward PE ratio of 10.9, so they're both pretty similar, but Walgreens looks like it's a little bit cheaper than CVS is. We can also look at its average PE ratio. This is the trailing PE ratio, and we can see that the average PE ratio for Walgreens is 21.5, but it currently has an 18.7 PE ratio. So from both of those metrics, it kind of seems like Walgreens may be a little bit undervalued. One of my personal favorite ways of valuating a company is by using a discounted free cash flow model, which I've shown that I had a script for before, but it's got some issues right now, so can't use that right now. But we can use this website called Simply Wall.Street, which shows all different sorts of data about the company. Their valuation shows that Walgreens may be as much as 50% undervalued from their analysis. So from all of this data, I think that it's definitely worth continuing to do more research into Walgreens, since it seems like their company is currently trading at a decent price that has a good risk to reward ratio. The next thing to look for is to see how a company will continue to grow into the future. We want these to be really long-term investments, so things that are in shrinking industries should be counted out. Analysts are expecting earnings growth of 21% and revenue growth of 2.8% for the next few years. With Walgreens, one of their newest competitors is Amazon, who recently announced that they are entering the pharmaceutical business, which makes up a large part of Walgreens' revenue. This is one of the reasons that Walgreens is at a much cheaper price than it probably should be. Another good way to see what the company has planned is by reading through their SEC filings and investor presentations. Going through some of their investor presentations, we can get a bunch of insight into seeing what they're doing in the future and how they performed over the last quarter. So this is the investor presentation that they had for the third quarter of 2021. One of the big things that Walgreens has been doing over the last year is, of course, administering the COVID vaccines, and they've administered over 25 million, with 95% of all their locations administering vaccines. They've also been giving out a bunch of the COVID tests, so COVID has brought in a lot of people into their stores, which has been pretty good for them. They were also able to exceed expectations with their earnings per share, their continuing operation costs, and their cash generation. In these filings, they also have their guidance for the next year. And from here, we can see that they, over the last quarter and the last year, that they've completed their divestiture of Alliance Healthcare. That's the A in WBA. They also show that their year-over-year growth has been really strong, especially since last year, a lot of people were forced to stay at home, so they couldn't really come to the stores as much. So year-over-year, it looks like they grew a ton, even though it's not really the best way to look at it, because they're looking into this time where no one was able to really go anywhere. They also, and then they have some of their financial guidance, where they're raising guidance from mid to high single digit to about 10% adjusted EPS growth. And then they list out like what kind of things that they're expecting to grow that will get them to this point, such as vaccinations, COVID recovery, and an increase in their investments. And then they also go through some of the investments that they're making. One of them is increasing operations with prescription automation, using automated micro-fulfillment centers that they are continuing to build in Phoenix and Dallas. They're also accelerating the Village Medical at different Walgreens, which they've completed at 46 locations and expect to have 35 more done by the end of 2021, bringing the amount of total co-locations to about 80. And then they want to continue to increase their capability of providing COVID testing and diagnostics. Their amount of memberships from their app has grown 34%. The amount of curbside and drive-through pickups has grown to about 6 million orders completed to date, and they've expanded national last-mile delivery capability. Internationally, with the Boots part of Walgreens Boots Alliance, they're launching innovative digital healthcare services like the Boots Health Hub, and then they're growing their market share in beauty products with 500 beauty brands that are now available after launching 34 more in the last year. And they've also helped the UK COVID response by administering 3 million tests since the pandemic start, and offering and operating 51 different vaccination centers. So this kind of stuff is really important to look at when you're looking at new companies, because it shows all the different parts that they are continuing to grow and what they think is really important to focus on, that they're growing in and making investments in for the future. With the discount that Walgreens seems to be trading at, I think that really helps manage the Amazon risk. So for the next few years, Walgreens should probably be able to continue growing their revenue and earnings at a pace that makes it an attractive purchase right now. Those two things are some of the most important things that you can look at for pretty much any company. You always want to make sure that you're getting it at a good price and that they are able to continue to grow into the future. But those aren't really particular to dividend companies. The next few sections that I have, they're all going to be dividend specific. So one important thing you want to be looking at dividend companies is their payout ratio. This is how much of their cash, after paying for all their expenses that they have to pay for every single year, this is how much cash that they have left over that they're using to pay for the dividend. In Walgreens' case, their payout ratio is about 40%, which is pretty good. For most companies, the lower the payout ratio, the better. Under 60% is usually where I want to keep it if I can. Sometimes some of them are a bit higher, but it's more on a case-by-case basis. The only exception to the safety rule is through REITs, which are required to pay out a much larger portion of their earnings, so they'll often have payout ratios above 80%. So just based on the payout ratio, Walgreens is also looking good. Next, we want to be looking at the dividend yield. This is how much you get paid out every single year based on the current share price. You get this number from taking the annual payout and dividing it by the current share price. So for Walgreens, it has an annual payout of $1.91 per share, and it has a share price of $49.45. So if you divide $1.91 by $49.45, you get 3.86%. Dividend yield can vary greatly from company to company, and especially across industries. Usually under 4% is pretty good, but I try to keep the majority of my yields under 3%. But in Walgreens' case, the yield comes from the stock being undervalued, so I wouldn't worry about the yield itself as much. And since their payout ratio is still pretty low, they'll be able to continue growing their dividend into the future. You want to avoid investing in companies that have a really high yield. This is a mistake that I kind of made when I invested with AT&T, because I thought, it paid a 7% dividend, so even if it managed to get cut, then it probably would still be okay, and their share price really hasn't been growing that much over the last few years. But I figured that the yield would make up for it, and then after holding it for about a year, they're like, "Oh yeah, we're gonna sell the growth part of our company and cut our dividend." So that was why I got out of that one. But I think Walgreens is probably going to be a bit safer than AT&T ever was. And speaking of dividend growth, this is one of the most important things that I look for in dividend companies. This is because I'm not planning on using the dividend income for myself, at least for 15 more years. So the current dividend doesn't matter to me as much as what it will grow to in the future. So if the yield is low now, but the growth is really high, it can still be an attractive investment. Apple and Microsoft are good examples of this. They both have pretty low yields, but they're growing at close to 10% year over year. For Walgreens, their 5-year compound annual growth rate is 5.3%, which is decent growth. It's a bit slower than what I would generally like to have. My average annual growth rate for my dividends is currently like 9%, but not every company can do that because that's pretty aggressive growth. Even so, this wouldn't be the slowest dividend grower that I had. Verizon is currently the slowest, which has about a 2% annual growth rate. So I think Walgreens would make a good middle of the road growth rate in my portfolio. Finally, let's look at the dividend history. We want companies that have a good history of paying and growing their dividends. This makes it much more likely that they'll continue to pay them into the future. Walgreens has been paying a dividend for 45 years and has been growing it for most of that time. It shows that Walgreens has a strong and stable dividend policy that they should be able to continue into the future. Overall, Walgreens looks like it's a very interesting investment at this point, and I'll definitely be looking more into buying this after a bit more research into their SEC filings and investor presentations to see how they plan on growing their earnings and revenue into the future. Now with that done, I do want to quickly talk about how my portfolio has done in the last week. As you can see in the thumbnail between last video and this video, I'm down about $800. A lot of my different holdings got hit pretty hard if we look here at the weekly performance of all of the companies that I have. Some notable things is Apple, which is down about 3.8%. Apple lost a part of the lawsuit that Epic Games had against them. That would now require them to have different forms of payment that apps can have instead of going through the App Store, which Apple takes about a 30% cut from. So that'll be a decent hit to their income. But overall, I don't think it's really as big of a deal as the market seemed to make it. Unfortunately, Apple is still overvalued in my book, so not really a time for me to buy yet unless it continues to fall even harder, which I hope it does. Johnson & Johnson and AbbVie were also down quite a bit. AbbVie is continuing its fall from the FDA and Rinvoq news, but then there's also news about more potential regulations against drug companies and the pricing that they can do. So that hurts all the different drug makers. REITs are also down a lot too, with Realty Income being down about 6%, Store Capital being down about 5.2%, and the biggest fall of all of the REITs that I have is Vici. Vici was first hurt just by the general decrease in real estate values across the board, but then they also had a share offering that they started to offer about $100 million worth of shares that they're using to fund their purchase of MGM growth properties. So overall, there was a lot of negative news that came out about my different holdings, but I really don't care about any of it. It just makes me more excited to buy into these holdings, especially now that a lot of them, my average purchase price is higher than what they are currently trading at. So I'll be able to dollar cost average my way down into a place where the price is even better than what I paid for it. Next week, we get September CPI data, so that should make next week pretty volatile leading up to it. After the big miss in jobs data, it'll be interesting to see what happens there. But that's it. I want to thank everyone for watching. If you enjoyed the video, be sure to like and subscribe and leave me any questions or comments down below. You can also email me at jacobmorrisinvesting@gmail.com. I will see you all next week. Bye.